Most people pick their retirement date based on when they feel ready, or maybe when their company pays out a bonus. But here's what most of us don't realize. The month you choose to retire can have a huge impact on your taxes. In this video, I'll compare retiring in December versus January. I'll show you how the timing can change your tax bill, and I'll help you figure out which option may save you the most money. Taxes are one of the biggest lifetime expenses for most retirees, second only to healthcare. And because income taxes are calculated each year, the difference between retiring in December or waiting until January can mean thousands of dollars in tax savings or extra costs. That's why it pays to get this decision right. Let's start with December. If you retire in December, you'll likely receive a full year's worth of salary plus any year-end bonuses. That income all gets reported on that year's tax return. But here's the catch. Higher income means higher taxes, and it may limit how much you can do things like Roth conversions or tax gain harvesting. On the plus side, retiring in December could mean collecting a bonus, maximizing your 401k contributions, and starting your retirement right after the new year. Now let's compare that to retiring in January. If you wait just 1 month, you may only have one paycheck for the year. That means your taxable income for the year could be dramatically lower. Lower income gives you more flexibility. You may qualify for lower Medicare IRMAA brackets. You can convert more dollars into a Roth IRA at lower tax rates. You may even qualify for 0% long-term capital gains tax on investments you sell. For many retirees, January creates the perfect tax gap year to make smart moves. Let me give you a quick example. Imagine a couple earning $150,000 a year. If they retire in December, the tax return for the year will still show the $150,000 plus any bonuses. They're stuck in higher tax brackets. But if they wait until January, their income might drop to just $10,000 or $20,000 in earned wages before retirement withdrawals. That opens the door for Roth conversions, tax gain harvesting, and lower overall taxes. Plus, you can still make a Roth contribution for you and perhaps your spouse too, because you have earned income and you're below the phase-out threshold. The difference could be thousands of dollars in savings simply based on which month you choose to retire. Of course, it's not just about taxes. A few other things matter, like bonuses. If your company pays bonuses in December, it may make sense to work through the year in, grab the check, and then retire right after. Also, healthcare. Employer coverage usually runs through the end of the month in which you retire, but not always. It's plan dependent. Retiring in December may give you coverage through year end, while January retirement may give you time to coordinate with Medicare or COBRA. Always check with the HR department. The other consideration is pension start dates. Some pensions, like FERS or CSRS, only begin paying on the first of the month. Retiring mid-month means your pension may not start until the following month, which is another reason end-of-month timing is key. And here's one more wrinkle. Required minimum distributions, or RMDs. If you qualify for the still working exception and your plan allows it, delaying retirement until January can actually defer your first RMD by an entire year. That's because your first workplace plan RMD is due by April 1st of the year after you retire. So if you retire in December, your first RMD would be due by the following year. But if you retire just 1 month later in January, you might not owe your first RMD until a year after that. That extra year of flexibility can be a huge tax advantage. So December or January, which saves you more in taxes? For many people, January creates a much lower income year, which opens the door to powerful tax strategies like Roth conversions and capital gains harvesting. But December can make sense if you want to capture a bonus, max out contributions, or if retiring earlier better fits into your lifestyle. The key is knowing which month aligns best with your tax plan, your benefits, and your retirement goals. Retiring a month earlier or later may not sound like a big deal, but it can make a major difference in your taxes and your cash flow. If you want to see more strategies that can shape your retirement, check out my video on Retirement Month Matters or Tax Efficient Investing. Don't tip the IRS. I'll see you there.